There is a 95-year-old man in Omaha, Nebraska, who still lives in the same house he bought in 1958. He eats breakfast at McDonald's every morning, drinks 5 Cokes a day, and he happens to be worth roughly $150 billion. If you walked up to Warren Buffett today and asked him what to do with your $10,000, the greatest stock picker in history would look you in the eye and tell you not to pick stocks. He'd advise you to buy a boring S&P 500 index fund. Then, in the same breath, he'd tell you that if he personally managed your $10,000, he guarantees he could earn a 50% annual return. 50% guaranteed. Both of these statements are completely true. Understanding why they don't actually contradict each other reveals the only 2 legitimate ways to build wealth. This graph compares market returns with debt. If you owe money on an 18 or 24% credit card, paying that off is step 1. Buffett compounded are 20% and cannot reliably beat that. Clearing it yields a guaranteed return no hedge fund offers. Step 2 is making sure your emergency cash actually works for you. High-yield savings accounts and short-term treasury bills are paying around 4 to 5%. Park your safety net there. Only after your debts are wiped and your emergency funds are parked can you actually start investing that $10,000. Let's look at Buffett's 50% claim. That number sounds absurd, but it relies on what he calls a structural advantage. When you have very little money to invest, you can be incredibly agile. In his 20s, Buffett found an obscure insurance company, took a train to Washington, D.C. on a Saturday, banged on the locked door until a janitor let him in, and interrogated an executive for 4 straight hours to understand the business economics. He drove farm to farm through rural Nebraska, knocking on doors to buy forgotten paper stock certificates from farmers who didn't realize what they held. Today, Berkshire is sitting on nearly $400 billion in cash. When you are that massive, tiny mispriced stocks are useless. An incredible $50 million company going up tenfold wouldn't even register on their balance sheet. The math behind astronomical returns is real, but it demands thousands of hours reading tiny print in financial manuals. It requires you to be a full-time financial investigator. If you don't want to spend your weekends cold-calling cornfields, Buffett's public advice applies. Put 90% of your cash into a low-cost S&P 500 index fund. In 2008, he put $500,000 of his own money on the line to prove this. He bet an elite firm that over 10 years, a plain Vanguard index fund would beat their hand-picked basket of hedge funds. This chart tracks the results. 10 years later, the Do-Nothing Index Fund had returned 125.8%. The hedge funds, with their premium fees and armies of analysts, averaged a dismal 2.2% per year. The index fund is completely devoid of glamour, but when matched against the smartest active managers on Wall Street, it consistently wins the race. Buying the index fund only works if you can survive the behavioral moat. The true threat to your portfolio is not inflation or a market crash. It is your own emotions. This bar chart from Dalbaugh illustrates the problem. In 2024, the S&P 500 returned over 25%, but the average equity fund investor earned just 16.5%. That gap is entirely driven by people panicking and trying to time the market. If you sell during a drop, the math punishes you violently. Missing just the 10 best days in a 20-year stretch cuts your returns in half. And those 10 best days almost always cluster right next to the absolute worst days. The stock market functions as an incredibly efficient machine. It actively moves money away from the impatient and gives it to the patient. Which brings us back to Buffett's 2 answers. They don't contradict. They just apply to your specific lifestyle and available time. You have to choose. You can dedicate your life to reading corporate filings to hunt for tiny, mispriced assets, or you can accept the index fund and walk away. Having only $10,000 means you can walk through doors that billionaires no longer fit through. You are standing at the exact starting line needed to build a compounding machine. Pay off the credit card, buy the index fund, and then execute the hardest, most profitable financial move of your life. Close the laptop and do absolutely nothing.